Welcome to the latest episode of the Intelligent Wealth Podcast. This podcast is for serious investors who want to grow their wealth, who want to invest in quality companies to become financially free. This is what we're all about. Obviously, don't take anything we say in this show as advice. It's purely our own opinions. Of course, the value of stocks can rise or fall. You may not get back the full amount you've invested. It goes without saying. So without further ado, I'm just going to introduce my two eminent co-presenters, Carl, fellow director of Minerva Money Management, and Awet, who is our head of research, no less. Topic today, which is, as I mentioned just now, this concept of high shareholder yield. It's not a metric I'd heard of until recently when I did discover it and wrote a blog on it, which you can find on the Minerva Money Management website. But basically, the topic is a comprehensive metric that includes dividends, share buybacks, and debt reduction. Three really important factors, and you can create a shareholder yield metric based on that.
Yeah, when you hear high shareholder yield, I think a lot of people, and when I've sort of first heard the term, a lot of people will think just naturally of just dividend yields.
Yes.
Because shareholder yields is just shareholder income. You're thinking, well, that's just the dividend yield. How much dividends is a share or business paying out to me as an investor? But like you said, there's actually a lot more to it, with the key one being these share buybacks.
Yes.
So if your listeners are not familiar with a share buyback, it's essentially where the company buys its own shares and takes them off the market. So rather than using profits to pay you a dividend, pay money directly to you, it's giving you a return in a different way. By buying back its own shares, it's reducing the amount of shares in circulation, which actually increases your ownership of what's left of the company. And I really like the share buyback idea because it's basically just maths, isn't it? You don't really need to understand it that well, because it's just that, if you own, one share in a company that's got 10 shares on the market and they buy back one of those shares and there's only 9 left, you go from a 10% holding to 11% holding through not doing anything. So I think, that's a really interesting.
In fact, it's a powerful the buyback. I didn't realize that. I wrote a blog about it, and I think he was motivated by the lecture of investor Monish Pabrai, and I didn't realize how powerful it is buying back your shares. And I think in the report, what he said is, I think if you buy back your shares 99%, without the PE multiple changing, and basically the investment would become 100 bagger, which is a £1 investment will become £100. So it's a powerful way of return value to shareholders. But I think one thing, buyback is always good when you, in terms of net buyback. For example, if a company buy back 10% of the share outstanding and issue 10%, it's pretty much net is zero, right? So it's always, we have to look at it in a way that is the company is just buying back. And when it's buying back, for example, when you buy back, you have to time it right, and you have to do it for the right reason why you're buying back. Don't buy it just to inflate EPS, earning per share, for that reason, to inflate earning. That's actually not a good cause. But when you find your shares are undervalued and you deeply believe the shares are undervalued and buy back, that's when it makes sense to deeply buy back your shares, because you are especially the management knows the business more than any outsiders.
Yeah, that's a really good point, Howard, because the net share buyback is a confidence booster to the business, isn't it? Because if you're the owners of the business, or the board of the businesses who all have shares in the business itself, they're not going to buy more shares in their own business if they don't believe in its future. So it's a good confidence booster for that company. And also the other thing that's good about share buybacks is that it's more flexible than giving out dividends, isn't it? If you're a company, once you start giving out dividends, money directly to shareholders, those shareholders are going to expect that dividend forever. and they're going to want to increase it. So you lose a lot of flexibility as a business. So if you go for a downturn, there's a market cycle, profits are just down for that reason. You really don't want to have to cut that dividend, because if you do cut that dividend, then you're going to be in all sorts of trouble in terms of the market. But with share buybacks, it's not consistent. It could be this year you decide to do it. The price is right. Next year you might not do. So it just gives you that little bit more flexibility.
Yeah, definitely.
Agreed. I also think it's a very good, what I call capital allocation decision, because all these three elements of the metric, dividends, share buybacks, and debt reduction, they're all capital allocation decisions. In other words, a capital allocation means how you spend your surplus cash, like you can do in your personal budget. You might decide to spend it all on entertainment or and clothes and things you don't need but you want. Alternatively, you could invest money. So it's a similar kind of concept to your personal wealth. So I do think it's a good capital allocation decision to buy back your shares, because also in most tax jurisdictions in the world, you're tax-wise, you're better off to have shares bought back than to be paid dividends, because dividends, certainly in the UK, you're going to pay more tax on your dividends at your highest rate than you'd pay capital gains tax on your shares being bought back. So I just think it's a really wise capital allocation decision in most countries in the world. I don't know the tax status of every country, so I can't comment on everyone, but I suspect this is the general rule. What do you think of that, guys?
I think one good point you made, Tony, is dividend is double tax, right? The company, when they earn, when they pay tax, they pay tax on dividend, and when they give it to investors, they pay tax again. So there's a double tax on dividend. So I always think it's not the best way to allocate capital. I would prefer debt reduction and buyback more. But dividend is if they have to do it and there's no alternative, there's a reason to do it. That's a good reason to do it. So historically, I prefer when company tend to reduce debt and buy back and do other capital allocation decision that will boost a long-term investors' value.
I'm conscious we've mostly focused on the share buybacks to the expense of talking much about debt reduction, for example. But of course, that's a really important capital allocation decision, because most companies go bust because they've got too much debt, same as in your personal life.
Right.
What do you think about that idea, guys?
I think, with debt, it's one of those things, isn't it? There can be a time, there can be good debt and bad debt, and there can be a time where debt can be a much more useful allocation of capital, all down to interest rates, essentially, isn't it? If interest rates are very low, debt is cheap. And you can earn a better return on that debt by investing it back into the business, then that certainly makes sense. It's just when debt is at a very high interest, that's just going to suck profits out of the company, isn't it? So that's when you want to be.
Yeah. I mean, I've written a blog about these companies that driven by purpose in Japan. I think those companies survived for 100 years. And the reason they survived is by becoming quite frugal, not having too much debt. That makes them robust, and they thrive and survive and evolve over time for hundreds of years. I think it seems, even when I look at most companies, the reason they fail is debt. And I think if you pay your debt and you buy back your shares, I think you are creating a lot of values for shareholders.
Yeah. And also, interestingly, from accounting purposes, when you think about it, if you've got a lot of debt, you've got a lot of interest, that's going to reduce your profitability. It may be the same outlay as buying back the shares or paying dividends, for example. But the thing with buying back your shares, that won't be reflected in the profit and loss account. And dividends, of course, are paid after corporation tax. They're not treated as a business expense. So you'd pay more corporation tax, like Awet has said, but it's a very different accounting treatment as well. But generally, I think it makes sense to minimize your debt, especially bad debt. You don't want bad debt. Good debt, if you're buying assets that are going to grow in value more than the cost of the debt, there's an argument for going for that.
Yeah.
Yeah, I think it's worth spending a bit of time on the dividend side as well, because I think when it comes to dividend yields, in particular in dividends, a lot of investors get it wrong in that they focus on the dividend yield rather than the dividend growing over time. So there's a perception that, if one company had a dividend yield of 6% and one company had a dividend yield of 2%, you might opt for the company that's paying the dividend yield of 6%. But there's usually a reason in the market. Now, we could argue all day about whether the market's efficient and all the information's known, the efficient market hypothesis. Right. But if a company is paying a 6% dividend yield, there could be a reason why that yield is that high, and it could be because the share price has fallen, and there's an expectation that dividend is about to be cut or is not sustainable. So there's no point buying high dividend yields if they're then going to be cut, the year after, and then consistently cut. It's much more profitable to go for a solid dividend yield that you can see is going to be increasing over time because earnings are increasing. That's much more the crucial point. But when it comes to dividends more generally, there's loads of market data out there and historic performance that shows that actually, the dividend reinvesting is what drives a lot of the returns of the markets. When you see some of these charts, if you look at, for example, going back to the 1960s, a growth of $10,000 invested in the S&P 500. If you just invested in the S&P 500 without reinvesting your dividends, that $10,000 from 1960 up to 2023 would be worth $796,000. But if you'd have reinvested all those dividends over time, it'd be worth over $5 million. Wow. So just showing you the power of dividends. But what I found interesting as well, looking at research for this podcast, was how dividends have changed, because back in the sort of 40s, 50s, 60s, dividends were a massive part of the overall return.
Yes.
So in the 1940s, dividends reinvested made up 67% of the return of the 1940s. But when you come back down to today, in 2010s it was 17%, and in 2020 so far it's only 15%. So I think that shows you where there's change to kind of growth stocks and these tech companies that don't tend to pay as much in dividends, but they might do some good share buybacks. I thought that was really interesting.
That is very interesting.
Great point as well. I think there was a research, it was done by this company called O'Shaughnessy Asset Management, if I'm pronouncing it right. What they did is they did a study for 32 years from 1982 until 2014. And they did study the S&P 500. If you invest $1, how much would it be within that period? And within 32 years from 1982 until 2014, if you invest $1 in S&P 500, it would become it would compound 12%, and it would become $35. But as we mentioned at the topic today, shareholders yield, if you invest in the top largest stock by shareholders yield, after eliminating the half of the stock universe within the lowest valuation and poorest quality, right? The $1 invested would compound at 18.43% annually in the last 32 years, and it would become $224. So when you combine what we said, shareholders yield with quality, with good value and good management, and you add few things on it, it becomes a powerful tool to use when analyzing investment. I think some quantitative investors, they factor that and they just allow to invest based on those factors. So historically it works, and some fund management use it.
I think there's a general rule of thumb. If you look at the track record of the S&P dividend yield over the last, say, 30, 40 years, it generally hovers around 2%. Obviously, if the market crashes, it goes up. So 2% is dividend yield, which doesn't sound like a lot. But if you factor in the buybacks as well on top of that, so you create this shareholder yield metric, that then becomes 4 to 5% a year, which is a lot more interesting, isn't it, compared to just solely relying on the dividend yield.
Yeah. I've got this very interesting table. Awet mentioned earlier Monish Pabrai, and when you buy back a certain percentage of shares, what effect it has on the share price. And there's a table here in front of me. If you buy back 50% of the shares, that doubles the return. Right. But when you get to a figure of 80% or more, that's when the magic happens. That's what Pabrai says. 80% of the shares bought back, you got a 5 times return. But if you get up to 99%, which Awet mentioned earlier, just to steal your thunder again, Awet, it's 100 times return. So I think these things are quite interesting. But what we mustn't forget when it comes to dividends, it's all very well having a company with high dividend yield and the dividends keep growing. But what about the share price? What I've found is quite often the companies that pay the highest dividends long term, more often than not, are more kind of old fashioned companies, shall we say. They're not that dynamic, and you quite often find the share price falls while the dividends are rising. And you think, well, hang on a minute, I've had all these dividends, but the share price has not performed very well. Whereas if you'd invested in, say, a giant tech company that doesn't pay dividends, but their share price has gone through the roof, you seem to be worse off. Now, I'm not predicting the future here, but I think you've got to carefully weigh that up as well. Look at the industry that it's in. Is it a really well run company? Is the share price going to rise as well as the dividends? Because there's no point having one without the other, I think.
Yeah, I think what investors believe as well, when company pays dividend indirectly, is actually that's coming out the company's earning. So
Yes.
the market value has to reflect that, and that's why the share price always, when they pay dividend, the share price always reflect
True.
that.
True.
Yeah, so
I
that's
think I think as well with that is we're looking backwards, aren't we? Whenever we produce these stats and we look at these graphs, it's always what's happened in the past. The problem with growth stocks in particular is that growth's already happened, isn't it? So we have to start from today and say, well, where's the returns coming from next? And it just sort of seems to make a lot of sense to me that if when you buy a business, or if you start your own business, or you buy a business, at the end of the day, you want to earn money from it, don't you? And you either earn that through selling it at a higher price later on, or you take an income from it in the form of profits. So I just think the key is looking at those companies that are able to grow their dividends year on year. And if they're able to grow their dividends, it means they're growing their earnings, essentially, isn't it? So that is a more kind of profitable company. But you always got to bear in mind that it's harder to, when you're looking back, it's harder then to say, right, well, where do we go from here?
Yeah, I mean, for example, for this podcast, I have two companies that I consider them. They pay high shareholders yield, and one of them is Shell PLC. As we know, Shell has revolutionized the way we frack, right? The way because they are technology, they ended up using water and so on. If you look at their dividend shareholders yield, it's 17.3%, and they have diverse of energy portfolio. And when you look at the dividend, it's actually 4.74%. And they've been buying back their shares around average 4% in the last 7 years. And they have been reducing their debt. I mean, in the last 2 years, they have reduced it by 3.1 billion. And they are investing in renewable energy solution. And I think they will benefit from these new Trump policies because they are issuing more licenses and so on. But when you look at it, it's actually the valuation is cheaper, but it hasn't been growing much. And I think that's the reason for it. It's a value trap. I think this it's not growing much because the market is going to grow much. In return, what they do is they can't find good capital allocation strategy. What they tend to do is give it back to shareholders. I think that's when you see companies doing that. And the reason is they have no great growth prospect. And there's a reason. So you either have to settle for growth, or you have to settle for dividend in other form of returning value to shareholders. That could be by paying back your debt and buying back your shares and so on. I think that's what they've been doing. Shells, for example.
Yeah, I found this interesting study on compounding quality, and it was featuring 15 cannibal stocks, and cannibal stocks are stocks where you buy back your own shares. And the number one on the list of 15, interesting, was Domino's Pizzas. This company has bought back 41.1% of its shares since 2020, and it's a company whose share price has risen quite a lot over that same period. So that's quite a good example. I think, as I was saying to you earlier, you need to be looking at both things really: the share price growth as well as the shareholder yield, and dividend yield. So, any other examples you can think of? I think you got another one up your sleeve, haven't you? You were going to mention.
Yeah, I can mention GSK, as we know. I think they have, again, the same thing. The shareholders yield is 12.7%, and they pay dividend, a big dividend, around 5%. And
Yes.
I mean, they are investing in research and development, for a lot of disease like HIV, respiratory disease, and oncology, and so on and so on, and vaccines. But when you look at the valuation, they haven't been growing in the last few years. They share, I mean, the revenue has been just flat in the last, since 2018. The revenue has been flat, and there's a reason why. As I mentioned, it's just similar. What you see is there's a pattern. The reason these companies do buyback, and it's just a different strategy in terms of capital allocation. You can't grow. If you can't grow, what do? You buy back your shares and you pay big dividends, and that's it. I mean, I think it's that they call it, I mean, I would call it value trap. This is a company that they are not growing, but you're happy to settle with this sort of return, an average return. As we know, the market grows, as Warren Buffett said, on average 7%. So you would get back by dividend and buyback together around 7% or 8%. And if you're happy with that, these companies will provide it.
Are they growing dividends though, Awet?
The dividend has been growing historically.
Because if the dividend's been growing, then surely they have to be growing their earnings.
Right. When I look at the earning has not been growing, and the dividend, I haven't checked it, but I can double check. Has it been growing or not? But 4.7% is still, that's like investing in bond. That's what you're getting now. Especially now, I think when bond is the return on bonds are higher, is becoming competitive as well with this company. Would you invest in a company that there's a risk on it, or would you go for investing in a government bond? You can still get around 4.5%. So
Visa's another very good company. It's a profitable company. It's a dominant company. It's in an oligopoly, isn't it, with MasterCard? They've bought back 43.4% of their shares since 2010. Highly profitable. It will keep rising in value, I think, the shares, and it will keep making more profits. It's got fantastic free cash flow margin, 61%, return on invested capital, 28.2%, free cash flow yield, 3.7%, expected free cash flow growth next 3 years, 15.7%, very dominant. So they're the kind of companies I like if you're going to go for shareholder yield.
I think the good things with Visa is they are like very dominant in their what they do. I think you have a good safety there in terms in comparison to like Shell PLC, which is their it's an energy. I mean, it is very competitive and so on, and it's very capital intensive. Where Visa, I think their business model is very strong business model, and they have a strong competitive advantage, and they've been around for years. And the more we use digital transaction, they will benefit from it. So they have a strong trend. They back in this sort of businesses.
I think it just goes to show you still got to come down to buying a quality company, isn't it? You've got to that company, even if the yield's high, it's got to be future prospects for it, and it's got to be growing. And I think I always say as well is you've got to understand the businesses you're investing in. Just because the numbers all look good, I always just think it's very dangerous to invest in something you don't understand, because if the news changes and you're not aware of how that news impacts the business that you're invested in, then it's very dangerous. So I think that's key, really.
Yeah. I think, as you said earlier as well, like if you factor the yield with quality, with other factors, it becomes a powerful way of investing. As we said early on, trustworthy management, and companies have quality earning, and when the shareholders, when the buyback is done on the right time, when the valuation is lower, I think historically they tend to outperform the market. Not just when the valuation is higher. When you buy a higher valuation, your starting point is higher. The return more likely to be lower moving forward. But when the starting valuation is lower and management knows that the company is undervalued, the right timing, the right management, and the right quality business, I think that is a powerful combination.
Yeah, I mean, I've always quite liked the dividend approach to investing, particularly for those kind of more retirement focused, because I just like that idea of never having to sell anything. So if you're building up shares or units in a fund, or you buy property, I just love that passive income approach. And to me, if you can just take all the income kind of from dividends and things as you're retired and never have to worry about selling any of your capital, then you don't really need to worry about downturns, market cycles, stock market crashes, all this sort of stuff, because you've got that passive income. And one thing I saw the other day, it might have been on compounding quality as well, is the approach where, because businesses tend to pay dividends, I think in the UK in particular is twice a year, don't they? I think America might even be quarterly. You could hold enough stocks that they generate their dividends in different months, so you can have a dividend payout every single month for the year if you buy stocks that pay their dividends out in different months. And I just quite like that approach. It's just quite easy for me to get my head around, and the fact I never have to sell anything, and you get this passive income.
Also, when you think about it, if you look at past charts of stock market performance, it tends to go a bit like this, isn't it? It's quite volatile, up and down, up and down. But if you look at past performance of dividends, it's almost a straight line up, apart from 2008, where there was a blip down and then back up again. But that was a very exceptional period. 2008, or was it 2000? I can't remember. Maybe both. But virtually every year, dividends will rise. And that gives, like you say, for that supports your argument, Carl, that you really wouldn't need to sell down your stocks. You don't even need to worry about share prices going up or down. As long as the dividends keep being paid, who cares?
And grow.
And they'll probably grow.
And it's also fantastic inflation protection, isn't it? Because these businesses, if they're growing their dividends, they're raising their prices. If inflation's higher, they'll raise their prices. Do you see what I mean? It's just a really good way of protecting yourself from inflation. So that should be an inflation-proofed income.
It's a good retirement income for people, I think, for sure.
Yeah, I think even if we factor high conviction portfolio, for example, we you add the shareholders yield, and you can only select companies with high conviction. And I think this strategy seems to prove to work historically. And when you combine things that you think, they are doing the right thing, and you have high conviction and high probability this business will outperform. And I think I think from the study that I looked into, I think it historically has done really well for investors.
Yeah, you just don't want to be in that trap of if you're a dividend lover, you don't want to be in that trap of, yes, the income continues to grow, it's inflation protected, but if your actual capital stays fairly static, like you mentioned, the Shell and another company earlier, Awet, you don't want to be in retirement thinking, right, well, I've got this nest egg I'm going to leave to my children. I'm going to earn all the income from it whilst I'm alive, but then because I'm not selling anything, I'm going to pass it all to them. If you've got a £1 million portfolio today and it doesn't grow, the capital doesn't grow, it's not going to be worth £1 million in 20 years' time, is it? It's going to be significantly less in real terms. So that's why the shareholder yield is so much more important, because in theory, you should have a growing company as well as growing dividends, which means your capital is going to appreciate as well as your income. And that's the ideal scenario, isn't it?
Absolutely.
Yeah, it is. I think even if when you look at the Western countries, even most central banks, I think we see there's a lot of debt. I mean, countries are getting more into debt. I mean, the US debt to GDP, UK. I mean, even Ray Dalio recently mentioned that UK is in debt spiral, which is central banks in going broke. I think how they will get out of this mess is through inflating currencies. And I think it's always good to invest in businesses that they will, compound over time, not just focusing on dividend, because dividend is not going to generate a great return. But when you find company that can generate a great return over time, they will become a compounding machine. I think that's what you want to be.
Guys, I think we've covered this in quite great detail up to now. I think it's been very useful having this discussion. I think we've come to the point in the show where we get into our fun section, which is recommendations,
right,
guys. So what's your recommendation this month, Awet?
I always love reading Howard Marks. If you guys know, Howard Marks is one of my favorite investor. And I think I always love to read his memos. I think this month, his memo was on watch bubbles. And he talks about historically about the Nifty 50, historically how, they were in existence in the 50s. I think they were powerful businesses like the Giant 7 today, but today they don't exist. I think even I looked at some study in, is it like 40 years, the company that they still stand on the top S&P 500 is Microsoft and Walmart and only few. The rest, they don't exist anymore. And he just remind us historically, it's always the trend reverses the mean. The things that we see today, it doesn't necessarily mean it's going to exist in the next few years or the next 10, 20 years. So what he advises, at the end of the day, trees don't grow to the sky. Things will always reverse to the mean. And his concern as well, the Magnificent Seven makes around 35% of the whole index, and they are accounted for around 70% of the MSCI global index. And at the same time, the Nasdaq is trading at 40 times earning. The speculation on Bitcoin, and people are driven by fear of missing out instead of thinking and considering if they're overexposed into the market to do the right thing. I think he just it's just a reminder always not to be driven by fear of missing out, but sometimes to be contrarian and to think different from the market.
Yes, good thinking. How about you, Carl? You got any interesting recommendations this month?
Yeah, I'm going for a book this time. Just recently finished it. The book's called The Fund by Rob Copeland. And it's a book pretty much all about Ray Dalio, which Awet, you mentioned earlier, sort of the manager of the world's biggest hedge fund, Bridgewater's. And it's not a biography. It's actually quite a negative book on the fund itself and Ray Dalio, particularly around his sort of working practices and management style at the hedge fund. There's some really shocking working practices. I believe Rob Copeland is a journalist who's had a few run-ins with Ray Dalio, and I think at one time there was a couple of opportunities where he sort of was nearly about to work for them in his younger days, didn't quite come off, and then he sort of worked for various newspapers, and he's just followed his career closely. But he sort of has a number of sources, people that have worked for the company, so you'd like to think his evidence is true. But it's quite damning on Ray Dalio, what he did with employees, and you read some of it and you think, no way would that pass HR laws nowadays. Really interesting, because he's quite obviously a popular and well-known person in the investing world now. But if you read this book, you'll probably have a different opinion of him.
Yeah, but also you probably got to balance it with what was acceptable then, that isn't acceptable today, I suspect.
Yeah, of course.
Because I've recently been reading this book called The Man Who Solved the Market by Gregory Zuckerman. It's based on Jim Simons, who's a legendary investor. He's sadly passed away a few years ago. Mm-hmm. But what was interesting about this guy was that he was basically an academic mathematician, a brilliant mathematician, but he employed many brilliant mathematicians and scientists over a very long career running this Renaissance capital and their own fund called the Medallion Fund. Now, interestingly, 30 years ago, he was using an algorithm, an AI, before it became very popular today. And it was all based on very short-term trades, predicting common movements in stocks. It wasn't based on any knowledge of the stocks or the stock market, just based on mathematical patterns that kept recurring, and very short-term trades, just for a few days, but many trades every day. And over time, after the first 10 years of moderate performance, the next 20 years, he produced extraordinary returns, the returns of the like of which I've never heard of any other investor, 66% a year for 20 years. Now, his hedge fund fees were very expensive, but you still ended up with a net 39%. I must say, if I was an investor, I'd still be pretty happy with that, in spite of humongous charges. So it was just very interesting, because it went to show he had to try lots of different things over many years, and he found that these academics he employed were very difficult to manage. They weren't very emotionally intelligent people, very, very trying. But by sheer grit and determination, he got there. And he was very, very secretive. He wouldn't give away his scientific solutions to this to anybody. So that was a difficult place to work as well. Probably not on the same level as Ray Dalio, but there was a lot of things going on in those days in the 70s and 80s used to be totally unacceptable today.
Yeah.
Interesting read nonetheless. It just goes to show that we think these are all modern subjects like AI. It's not. It's been around for a long, long time. So that's my story.
I think one thing I love about Jim Simon is he's always said it must be a way to do it. He doesn't always see he always think there must be a way to do it. And I always find it a powerful reminder. We always have to think there's a way. If there's a will, there's a way, as I say.
There's a resilience there, isn't there?
Yeah.
This determination to succeed. So that was quite an interesting story. I always think these books are more interesting when they're more biographical or autobiographical. When there's a story, it's much more interesting, like Carl was saying about his book.
I wonder why Warren Buffett loves biography. He always read biography. That's probably the reason.
It's just more interesting.
But sometimes I think it's good to balance it with a biography with an autobiography, isn't it? Because your autobiography is always going to be obviously heavily biased, isn't it?
Yes.
Whereas a biography should be a bit more, non-biased, shouldn't it? I mean, sometimes the person will employ the biographer and direct them exactly what to say. But if it's a genuine independent kind of biography, I always think that's a good balance.
Yeah.
Different view, isn't it?
Jim Simons was a biography. It was based on interviews with lots of people that knew him and had worked at Renaissance, because he was so secretive. He wouldn't agree to autobiography at all. Anyway, sadly, we come to the end of the show. It's been great fun, a very interesting input from us all. We will be putting links in the show notes. Please do give us a review for the podcast if you're listening on Apple Podcast app, because that helps us go up the rankings, allows us to attract along more quality guests. And we will be having occasional interviews with some great fund managers and investors in the coming months. So thanks very much, gentlemen, for your time today. It's been very enjoyable. Well done. And good luck to you, listeners, with your investing, and hope you have a lot of fun and become financially free very soon, if you're not already. Have a great day.
Thank you for joining us today. Please help us spread the word by sharing this podcast with your family and friends. And don't forget to subscribe.